Hello, everybody. Welcome, welcome. Thank you for joining us in another edition of our Self-Directed IRA Saturday. We have a great show today, a great presentation. We're excited. We have Sherman Arnowitz with us from Keyhole Connect. He's going to be talking about the lucrative world of investing in mobile homes. Super excited about this topic. I've always find it really interesting. Can't wait for that. My name's Andrea, and I'm an IRA specialist here at Quest. I'd like to go over a couple of slides as per usual before we go ahead and bring our speaker on and start with the main presentation. As we always start, of course, with our disclaimer. Quest Trust Company does not provide any tax, legal, investment, or structuring advice or endorse any products, services, or investments of any type. All information and materials shared here today are for educational purposes only, and all parties are always encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. But thank you for joining us. I hope y'all are having a great Saturday so far. Here in Texas is finally cooling down, and I'm excited about that. We're having a wonderful morning so far. I do want to go over this new promotion that we have going on. If you haven't heard about it yet, it's going to go through the month of November. This is going to cover, we're going to credit you $125, which basically covers your first investment when you open an account at Quest. So tell your friends, or if you've been, on the brink and waiting for a good moment to start your investments, to open your account, now is a great chance to do so that you can take advantage of this promotion. Again, typically $125 is what we charge when you fund into your first investment or any new investment. So this will cover that for you, okay? That's the code, November 125. But let me know if you want me to send you an application. I'm going to share my email address in a second here so you can reach right to me. And then we have, this is a QR code to scan if you want to have a consultation with an IRE specialist like myself. We have a great team of about 7 of us. We're ready to talk to you, to answer any questions, to go through any process, anything that you want to talk about, self-directed IRA investing related. We're here for you, okay? And this is the code to scan. We are coming up here for those of you who are in Texas or who will be in Texas on November 7th, 9th, and 14th. So coming up here shortly. Super excited about this. It's our biggest, networking and social events that we always put together here. Last time we had it in our Houston one, which is our main office. We had upwards of 200 or over 200 people join. It's going to have a panel. They're going to be going over the rental continuum, decoding short-term, midterm, and long-term rentals. But there's also going to be, people with projects there, some of our sponsors, and a lot of people who are looking to fund their next deal, who are looking for their next deals to network. So it's a great opportunity to network and to make friends and find your next deal and fund your next deals. Okay. Of course, like always, we provide free food and drinks. So you can always just join us for that as well, for the fun. And then this QuestCon Live event that we're streaming live on November 17th is going to be an amazing one. I'm super excited about it. I'm actually running two of the panels, and I was meeting with one of the panelists, some of the panelists yesterday, and there's just such cool women. These are leader women in our alternative asset world investment, and they are just gonna kill it. And I'm just so excited. All the topics that we're covering are great. They're just super interesting. It's free, so that's always a good one. We typically charge for the QuestCon Live every year, but this one we decided to do it free. So register, please. Even if you can't attend, or if you're working or something, we can send you we're going to send you the recording after. So take a moment right now, scan the QR code and register, and share it with any women. Women, and of course men are welcome as well. But I think this is going to be a really, really cool event. We're also going to have keynote speaker Mary Moore. She was there when the Roth IRA passed through Congress. She was there with Mr. Roth. So she's going to be talking as well. And I mean, super excited about it. And then we have our expo next year, that we're promoting already because we have early bird tickets now. So, if you attended our last ones, they've been great. Always an amazing opportunity. So much education shared. So many interesting and important people there in the world of alternative asset investing. So all in all, a great time always to join us. So go ahead and scan the QR code too if you're interested in get some of those early bird tickets. Okay. That's all I have for now. We're getting ready here to bring up Mr. Arnowitz. We're super excited for his presentation. Hello. How are you, Sherman?
Great. How are you doing, Andrew?
Great. Whenever you're ready, let's bring up your PowerPoint and take it away.
Perfect. Thank you very much. I'm very excited to be here. My name is Sherman Arnowitz, and I am the president of Keyhole Connect, as well as another company, Keyhole Financial. So my goal here today is to introduce to everybody as much as we can about financing mobile homes and the history of mobile homes and where they came from and the evolution, where they are right now and where we believe they're going to go. So without further ado, here we go. So believe it or not, that's me. I was born in a small town in Pittsburgh, Pennsylvania, to a family of 14 brothers and sisters, and life was very, very hard. I used to walk 5 miles to school. I'm just kidding, but that is me, and I was born in Pittsburgh, Pennsylvania, and only there were 4 of us, 2 brothers and 2 sisters, and all of them are hardcore entrepreneurs. So we have a lot of fun at Thanksgiving. So this is me. I now live in New York, and I've been in the alternative investment space for over 27 years. So the story goes, when I graduated college, my best friend and roommate, we'll call him Mark, asked to borrow $15,000. It was a deal that he promised me, give me the $15,000, I'll pay you back within 30 days, and I'll give you an extra $3,000 or $4,000. And so I lent him the $5,000, and 30 days went by, and 60 days, and 3 years, and 5 years, and 10 years. And 15 years went by, and I got a certified check in the mail for $15,000 with my roommate Mark's name on it and a phone number. And so I called Mark up, and of course, the first thing that I said to him was, where's my interest? And we just got to talking, and Mark started telling me about what he was doing, and it was a very, very unique concept. And what he was doing is he was investing in non-performing second mortgages, and he would go to the banks, and these were second mortgages where the borrowers had a first mortgage and they took out a second mortgage, maybe to do a bathroom or a kitchen or whatever it is. And so they took out a second mortgage, and something might have happened. Maybe someone lost a job, and they would stop paying on these second mortgages, and the banks would try sending out letters and phone calls. And after a certain period of time, the banks would rather write off these loans. And so they would sell these second mortgages to investors at heavily discounted rates. And so my roommate Mark started telling me this story. And as it turned out, the timing was perfect because I was moving away from an existing job that I had, and I was looking for something. And so I believe the universe kind of shook the doors and opened the opportunity for me about these investing in second mortgages. And so, to my college roommate's credit, he started training me on everything about that I needed to know about investing in these residential second mortgages. And we would purchase these second mortgages all over the United States. And again, because they were second mortgages, the downside, they were just like the senior liens and we could foreclose on them, but they were in the second position. And so that was really the only dangerous part, that if the first senior lien holder wanted to foreclose and there wasn't enough equity, we lost out on our investment. But as it was, I did it for over 25 years, and how it would work would be I would research these loans from banks, and there was a fair amount of due diligence to these second mortgages. And I would then make an offer to these banks, and these banks would rather have something, and they could write off whatever they needed to write off. And so I would create these funds, and a fund could be anywhere from 20 loans up until 400 loans was our largest. And so we would create these funds and we would purchase them. And in order to purchase them, we would go to private investors and we would ask private investors if they wanted to invest. And so once they started investing, we started doing the managing of them. And there was also, besides the art of the due diligence of finding the loans that we wanted to buy and at what price, now that we had the loans, now the second part of loan management came in, of trying to skip trace and find the borrowers. Once we found the borrowers, it was a matter of informing and proving to them that we actually did own their notes. And once they came to that point where they believed that we did in fact own it, there would be a lot of silence, and it would be more now a matter of, okay, let's talk. And our belief was we wanted to work with the borrowers, and it would be a matter of, listen, we know you owe us $40,000. Your monthly was $600. What can you afford to pay? And how they got into this mess, some folks believe that the brokers, the mortgage companies had no business approving $1 million, a $700,000, whatever mortgage to somebody who couldn't really, and showed that they couldn't really afford it. As well as the other side of it is a borrower knowing that they really can't afford to make these payments. But that's how we got in. And so that's how we got into this mess. And that's how we got into this mess in the 2008 era. And so when we would be buying these loans were loans that were originated in 2000, early 2000s, 2000, 2001, 2002. And they might have been performing, and they were performing for a certain period of time. But then whatever happened, they stopped performing. And that's when we came in. That's when we purchased them at heavily discounted. We would buy a $40,000 second mortgage for 10 cents on the dollar. And so we would pay $4,000 for it. Obviously, the borrower didn't know that. But yet when we were speaking and when we finally found the borrower and proved to them, we wanted to work with them. And so, look, you owe us $600-700 a month is what you're paying. It's the $40,000. Well, you can't afford the $600. What could you afford to pay? Okay, you could only afford $300 a month. Great, we'll put you on a temporary payment plan of $300 a month, and we'll do it for 6 months. And if you can prove yourself that you can make these payments without missing any payments, then we could talk about doing a loan modification. And you have to remember, a lot of these borrowers that we were going after, they hadn't been paying their second mortgage anywhere from a year, 3 years, 5 years, 7 years, whatever it was. And so we had to kind of create a new habit for them to say, yes, you do have a second mortgage now, and you need to start making these payments. And so it was great. We would reach out to our private investors that we amassed along the way, and we would create these funds. And if a fund cost us $2-3 million, we would go to these private investors who would invest anywhere from 50,000 and up. And then we had a management program where we would give out 80% of the profits to the investor. We would keep 20, and we would continue this. These were 5-year funds. And usually at about the 3-year point, we would break even. And so by giving the investors 80% and us 20, at around the 3.5 year point, we broke even. And at that point, we then would go 50-50 with the investors up until the end of the fund. And each fund, if we averaged out each fund, and we had about a dozen funds, we averaged the net return on our investment for the investors between 20 and 30%. So everybody was super happy. All of my investors were super happy. But what I was finding is that over the last 3 or 4 years, my little secret was no longer a little secret. And so more and more investors were finding out about the second mortgage space, and they were coming into the market. And that was causing a heavy supply and demand issue. And so what we were finding is that residential second mortgages were harder to come by, were harder to find. Of the ones that were interesting enough that we were interested in buying them, because there were so many people in the market space, instead of paying something that would normally go for 30 or 40 cents on the dollar, which made sense, they were getting bids of anywhere from 50 to 70 cents on the dollar. And it just didn't make sense for us. You can't really make money when you're buying something that high. And so we really saw the writing on the wall. And so, again, as it turned out, the universe started shaking around, and I got a phone call from one of our investors, and he said to me, hey, I own 5 mobile home parks, and I am the bank, and so I finance everything. And so when someone comes to me and they are interested in lot number 10 and it's $50,000, I try to get a certain amount of down payment from them, and then I finance the rest. And he said, quite frankly, I don't want to be in the financing business. I know you have a large database of investors, and you did well by me, with the residential second mortgages. I thought I'd bring it up to you, and maybe you could come up with something along the way here. And so what happened was I did my research, and I saw that there really was a lot of opportunity, and it was something that it was a next chapter for me, and it was something that I found incredibly interesting. It's just, I thought that the residential second mortgages was something that was completely off the wall. And when I would tell people what I was doing, the first thing that they would say is, I never heard of it. And the second thing they would say is, oh, you kick people out of their homes. And I said, no, it's just the opposite. We keep people in their homes. And because we buy at such a low rate, a competitive rate, that's our goal, to keep them in their homes and to come up with some sort of loan modification. So all of a sudden, I came into this brand new market that I knew absolutely nothing about 4 years ago. And I just saw that the potential was just unbelievable. And as it says, there's 20 million Americans currently living in mobile homes. The number is expected to grow by 10% annually over the next 15 years. There's a high demand for affordable housing. It presents significant challenges, especially those with low credit scores. So what I found was, number one, the manufactured homes or mobile homes, same thing, we'll get into that. It really was the last frontier of a place where people could purchase affordable housing. It was an opportunity for those that don't have these opportunities to get into a marketplace of affordable housing vis-a-vis these mobile homes. And so what we were really seeing is, as far as competition goes, is here we have a mobile home, and really the competition, the initial competition, is the apartments and renting apartments. And so that's when we talk about affordable housing, that's one of the things that we look at. And for us, when we're dealing with prospects, that's one of the competition that we're looking at. They're deciding, do I want to continue living in an apartment where I'm paying $800 a month for a one, maybe a two bedroom? Or do I want to pay $1,200 and I can get into a mobile home in a mobile home park? And at least that's something that we could do and earn some equity. And that's really the challenge. And that's the learning curve that we present to these prospects. So what I found was this incredible opportunity that was out there, and I was kind of shocked and to see that it's really such a affordable solution. And really the challenge that I found when I would go to some of these shows and to see who's out there, the challenge was finding borrowers, providing the borrowers, with a reputable source of financing. One of the things I'll say is one of the largest financing companies out there is Warren Buffett's company, 21st Mortgage, and they're gigantic, and they are competitors, but they're really not competitors. And we'll get into that in a little bit of why I don't consider them competitors. But first off, as many of you may or may not know, in the 1976, because of the public's poor perception of mobile homes and trailer parks, the industry changed its name to manufactured homes. Today, we still go by mobile homes, but the negative connotation that folks had with trailer parks, mobile homes, they thought that this would be an ideal solution to change the names from that to manufactured homes. And so in our industry, sometimes when you kind of say mobile home, you'll get a tisk tisk from people that they like the sound of manufactured homes. And even the trailer parks, which are really now called mobile home parks, and they're not even mobile home parks, it's really mobile home communities. It's kind of like the Dunkin' Donuts or the Kentucky Fried Chicken is now just Dunkin' or KFC. It's kind of similar to that. They want to get away from it. And so it's really manufactured home communities. And these communities, some of them are just awesome. And what we're finding is happening is that there's a limited amount of space that's dedicated to mobile home communities. These mobile home parks, mobile home communities, they've been licensed, they've been zoned, and they've been grandfathered in. It's very, very hard right now to find space, to find land that you can zone for manufactured home communities. And so because it's really a set number, and there's about 43,000 communities out there, knowing that it's going to be very difficult to add more communities in the United States presents opportunities, but it also presents some problems also in regards to folks are buying, young entrepreneurs, companies are buying these manufactured home communities from the older mom and pops, and they're sinking a lot of money into these spaces, and they're adding swimming pools and community homes, little mini markets for everybody. Tennis court, I've seen one with a tennis court and a pickleball court. And so they're really adding value. And one of the things that you need to know is that when manufactured homes are in communities, the financing of the mobile homes is one cost. The lot rent is another cost. And the difference is the financing comes to the investor. The lot rent goes to the park owner. With these manufactured homes, and excuse me if I go back and forth between manufactured or mobile, but with these homes, when they're on the property, all they really have as collateral are the mobile homes. The land that's underneath them is owned by the park owner. And that's how the park owner makes money, by collecting that monthly lot rent. And that monthly lot rent can be anywhere from $300 up to, I've seen it up to $1,500. And so today, there's an estimated 4.3 million manufactured home sites in the US. When I say a site, we call them mobile home pads. So a manufactured community might have 200 pads in their community. And of the 200 pads, maybe 100 of them have homes on top of them. And so there's 100 that are open. And so that's what we mean by 4.3 million of these sites. Those sites are the pads. 27% of the new manufactured homes are placed in a community versus on private property. And the United States has about 43,000 manufactured home communities. Again, these are communities where what we're looking at in this picture is a community with a beautiful lake in the middle, and they're as nice as this, and they run the gamut everywhere in between. So one of the things that I found out, and one of the things that I stumbled on when I started doing this, I just thought, all right, I'm just going to go into the financing of mobile homes. And what I learned when I would go to some of these trade shows and seminars and webinars and stuff is there's a very distinct line between the prime market and the subprime market. In the prime market is a market that's offered to borrowers with higher scores. Because they have higher scores, they believe that there's less risk, and so therefore they're able to offer lower interest rates. The financing company uses the prime rate. More financing companies, most financing companies offer loans in the subsection. When I was talking before about Warren Buffett's company, 21st Mortgage, and there's others, Vanderbilt and Triad, that are out there, their specialty is the prime market. So for instance, if a borrower, they're looking for borrowers that have credit scores 660 and above. And if someone came to them with a credit score under 660, they wouldn't do business with these people. And so what I found is there's just a tremendous market for the subprime market. And the subprime market are these borrowers that have lesser credit scores. Because they have lesser credit scores, amongst other things, there's higher interest rates and higher fees. One of the things that we'll talk about when we talk about these mobile homes or manufactured homes, when we're looking at financing them, we look at them and we consider it to be either a personal loan that we're offering these borrowers, or sometimes you'll hear chattel loan. And a chattel loan is offered to products that can move. A mobile home, as you saw in the pictures, they really can't move. A trucking company is going to move them from site A to site B. They're going to put them on these pads in the community or in private property, and then they really cannot be moved. It's not like you can put wheels on them. And because of that, they're considered chattel loans, just like a car is considered to be a chattel loan. Okay. So what I found was this subprime market was a market that no one was really focusing on. Everyone just wanted a big piece of the prime market. And what I decided to do is really create a program that focuses mainly on the subprime market. And how we did that, that made it fair for everybody, is the first thing. Okay, somebody has a FICO score, a prospect has a FICO score that's less than 660. It's a factor, but it's not the factor. Okay, so what we'll do is we'll put that on the left-hand side of the paper. Okay, they have a credit score of 570. Not great, but that doesn't mean that they're a terrible prospect. And so there's other factors that we're going to look at. One of the main factors that we're going to look at that's going to hopefully put on the right-hand side of the paper is the debt-to-income ratio. And the debt-to-income ratio says, prospect, if you make $1,000 a month, using this for easy numbers, if you make $1,000 a month, that's your income. And so what we internally have decided is 57% is the most that will allow you to have as debt. So in the case of you having income of $1,000, you can have up to $570 of that as debt. There's your debt to income ratio. If you have $570 or less of that ratio, that's a big plus on the right-hand side. We have the credit scores on the left side, and so we have a negative on the left-hand side. And if you have that debt to income on the right-hand side, and it's 57% or less, that's great. Other factors that we look into are your proof of income, the prospect's proof of income, credit lines. So we'll look and we'll say, okay, your credit score is not great, but your debt to income looks really good. Let's talk about some of your credit lines. Your cable bill. Can you show us that over the last 2 years, you've made every payment, you've never missed a payment, and you've never been late on that cable bill or phone bill or insurance bill or car lease? And we have about 20 different credit lines that we look at that we give the prospect the opportunity to show us that they're a good gamble. And so we need to do our due diligence. And so if those credit lines, and they can prove to us those credit lines that they're good, those are all going to go on the right-hand side. So we're looking at that, or I should say the underwriter is looking at that. Employment history. How long have they been working for the company? These are other things that our underwriters are looking at. Rent verification. In most cases, most of these prospects have a history of rent. How are they been doing? Can we get a letter from the landlord stating that you were a good tenant and that you were making your payments on time and you weren't missing or you weren't late? Other and lastly, really, is the Social Security. We'll take Social Security number. Everyone has to have one, or they can also get they can also provide an ITIN number, which is another form of identification. So these are the factors that we look at. These are the factors that the underwriter looks at to determine whether this prospect is going to be good risk or not. And so by looking at all this, we can make that determination. We move further on to this. One of the things we do is we can finance on a park within a park community or on private property. And there's benefits, to both. Here I have park community. It's a neighborhood feeling. There's people around you. The park management is on property, so that's another good thing. There's usually amenities that come with it. We require a minimum 10% down payment is required off of the list price. If they're buying that unit for $50,000, 10% of that is $5,000, so they're going to finance $45,000. On private property, advantage here is it is private. quiet surroundings. There's no lot rent. Remember what I said on the park community, there's a lot rent, and that goes to the park owner. Private property, there's no lot rent. They really don't have on the downside on a private property amenities. With the private property, it's a minimum of 25% payment down. And the reason why we're asking for more on this is because at least within a park, there's a park manager. And that park manager can keep their eyes on everything within the park to make sure everything is good. When we finance on private property, we really have no way of really checking how they're treating the unit. And so that's why we require more. And the thought process is that we want people to be involved in this, and we want people to have skin in the game, and hence the down payment here. So it really depends on what, we just had a fellow who purchased down in Florida, half an acre of land for about $15,000. And then he moved a unit on his property. He paid $50,000 for the unit and another $20,000 for transportation and setup. So that's 70 plus 15 for the land. That's 85,000. We checked on that property about a year later, and that 85,000 was worth about $200,000. Hence the time and the appreciation on that. So, can you afford a mobile home? Here I say in 2022, the average cost of a mobile home was about $125,000. That's a new unit. I give a breakdown of the United States. Underneath that, mobile homes come in different sizes, 1, 2, and 3 sections. Most of the stuff that we're financing is used, and it goes from 1970 on up. The average, I'd say, that we're doing on financing is about $50,000 for a used one. And a used one could be a single wide, a double wide. I haven't done many. I think I've done one triple wide, but most of them fall into the single wide and the double wides. Why interest rates are higher with mobile homes? As I explained before, they're chattel loans, and chattel loans with themselves, it's just the collateral. Here I have that mobile home. It's on land, whether private or in a community. That's my collateral. Not typically, you can't go to a bank, a traditional bank, and say, I want a loan for my mobile home. They won't do it because you don't own the land underneath the mobile home. So no traditional bank will lend on that. Interest rates are also higher because in the subprime market, there is a depreciation factor in some locations, but also just like a home, there are certain things. With mobile homes, manufactured homes, I think the depreciation factor, because of what we're dealing with, the size, the elements, that these are things that come into play with the interest rates. Every single one of our mobile homes has to have constantly home insurance, and that's obviously a protected for us. It's for our investors, a protection, and it's also a protection for the homeowner as well. So here we have the benefit to the borrowers. And what I wanted to do when I created this program is I wanted it to be where it's a benefit to the borrower, where it's a benefit to the seller, and where it's a benefit to the investor. So all of them have these benefits, okay? And our program, we afford the financing options, and really the key here for us is it's specifically targeted to the subprime borrower. And these are folks that never, ever had the opportunity that they could go ahead and they could buy something that would turn itself into equity, and so that they kind of own a piece of the rock. And we take that very serious when we do our customer service. We want to make the experience that they have with them as great as possible. And so determining that we'll finance any model and year, Our financing ranges from 15 to 150,000. The loan term for us is from 5 years up to 10 years. Other companies want to do it 5 years to 25, 5 to 30. We wanted to do it, and we spoke with a lot of the park owners who really also believed if we could do it on a shorter term, there's more of a psychological mindset that the borrower has when they know, hey, within 10 years, I'm going to own this, versus that mindset of, oh, I have 25 years until I own this. So our interest rates, which are typically higher than most, because we're dealing with the subprime. And for us, our interest rates are anywhere from 14 to 17%. And when I tell that to people, they're, oh my God, I can't believe you're charging 14 to 17%. And the reality here is that in the subprime market in particular, I'd say out of 100 loans, there's probably 98 of those 100 are looking at this, and they're looking and they're saying, okay, it's $40,000. That's $750 a month. The lot rent is $250. That's $1,000. Yep, I could afford $1,000. That sounds great. And like I said before, a lot of them are going to compare that to what they were paying or what they could pay in renting an apartment. But even if it's more doing it our way, we try to convince them and show them that you're picking up equity. Here's an opportunity for you. And that's one of the benefits that we have for that borrower. Benefit to sellers. So the sellers, in particular, how I got started in this, that park owner who does not want to be the bank, and they've got to scrounge around and they've got to deal with these folks on a regular basis, as well as other things that they have to be responsible for if they're renting to these folks or versus if they're financing to these borrowers. And so alleviating that and letting them focus on other things rather than collecting money and dealing with insurance or the roof and any of that stuff, they're able to take that money and they're able to buy more mobile homes and put more mobile homes on those mobile home pads within them. And for them, that's the name of the game, because that's how they're going to make money. They're trying to create an asset for the park so that the exit plan is that one day they can sell it. And if they have 200 pads and all 200 are filled, they're going to make a pretty penny. So that's one of the advantages that we have to the sellers. To the investors, the benefits, it really becomes a win-win-win. Our investors, they finance mobile homes on a loan-by-loan basis. They receive a return based on the amount that they are willing to invest. We obviously have investors that want to invest a lot of money, and so we give them a higher return. Keep in mind, we're charging the borrowers anywhere from 14 to 17%. And so there's a certain number that makes sense for us because we're going to, we're in the middle, we're putting this together. And so we calculate that, and then we're able to give those returns to the investors. One of the things that makes what we do different than anybody else that's doing it is we have something called a loan guarantee. And the loan guarantee states if a borrower ever defaults on their loan, the park owner or the seller who was sold this, it could be a mobile home dealer, it could be a flipper, whoever the seller is that signs that loan guarantee, says to the investor, hey, investor, if this borrower ever defaults on their loan, 5 years, 6 years, 7 years, up to 10 years, we'll take over the loan. And that, to me, hence the picture, is the cherry on top. And what people say is, why in the world would a park owner want to do that? What happens is other financing companies, such as a 21st, they'll lend money if the borrower is prime borrower, but they'll lend money to the borrower. And if the borrower does default, what they do is they'll come in, they'll have a public auction. The highest bidder is going to get the home. And if that bidder, that new owner, lives outside the park, they're going to pay a trucking company $4,000 to $6,000 to move that unit out of the park to where they want to go. And here lies the park owner with tears coming out of his eyes, waving goodbye to this mobile home. And now he's got to find another mobile home to put on that pad. And that's why the park owners love the guarantees, because they're going to, up front, we're going to contact the park owner, and we're going to say, hey, park owner, this bar has been missing payments way too much. You have 30 days to fix it. Try to get that borrower to make payments to us to catch up so that they're current. If you can't, after the 30 days, the spotlight's on you. And now you have to evict the borrower, which takes about 30 days. You're going to refurbish the unit, and you get to resell the unit all over again. So it's a win-win situation. The park owner gets, or the mobile home dealer gets to resell the unit. In most cases, he's going to make money off of it. And the investor's happy because the investor, we tell the park owner or the third party, we say, look, you evicted, you refurbished, and you resold. Behind the scenes, you have a choice, park owner. At the time that this borrower defaulted, it was $37. Option one is you could wire me $37,000. Option two is you can continue to pay the $650 a month that the borrower was paying. That borrower is out. The park owner is refurbishing the unit, and he's paying $650 a month, let's say for 2 months. It's now, he's found a brand new borrower that wants to buy it. He brings them to us, and then we settle up how much the park owner owes us versus how much they paid. So it really is something that's completely different and really gives the investors peace of mind with that. So here's an example of what we come up with, and I don't want to really go crazy over this, but someone financed $25,000 for 7 years. That net profit was $13,000, and we were able to give the investor an 11.57%. So you can see them as they're going down here. Our belief is that as interest rates in our economy are going up, we also are going to increase the interest rates that we're charging to the borrowers. Quick statistics, the borrower statistics. As I said before, the average is $50,000. Interest rate average is 15%. 8-year term. Their monthly is $900. Average, and the default rate is 4%. Now, I say the default rate's 4%, so out of 100 loans, 4 of them are going to default. But because we have that loan guarantee, no one lost money. Out of the 100, 3 of them paid back the unpaid principal balance, and 1 of them continues to pay on a monthly basis. For the investor, the statistic averages are, if he's financing $50,000, there's a broker fee of $5,000. There's also additional fees, the underwriter fee, closing fee, etc. But their gross profits off of that 50 is 86, and net profit of 31, around 12%. Here we have some of the states that we're in. We work with 3 underwriters. Between all 3 underwriters, they're licensed in these states here. So we have a pretty good presence for that. So that is my presentation on financing mobile homes. I hope you enjoyed it. To me, I get so excited about the opportunities that are out there. For us, it's very exciting because I'd say about a year ago, we were maybe getting 10 inquiries from potential borrowers on a weekly basis. And currently we get about 10 a day from prospects looking to borrow from us. So I hope you enjoyed it. I hope I wasn't too salesy, but that you all learned something, especially that I was born in Pittsburgh. So we'll open it up, I guess, Andrea, for any questions
Yes.
you has.
Thank you for that. That was awesome. And I loved how you started with your own story and talk about your investments that you did back in the day with Second Lien. That's awesome. Super interesting. Thank you so much. We do have a couple of questions that came through, so I'm just going to post them here on our screen and I'm going to read them out for you, Sherman, if that's okay. One of them is, can you provide some website in Texas where mobile homes are sold, mainly interested in not attached to land? Thanks.
I have a fellow, and this person could get me. I think if you see info@keyholeconnect.com, I have they just come out of the woodwork, and I have somebody in Texas. I have a couple people in Texas, but one guy in Texas, he's right on the border, and he's a mobile home dealer, and he contacted me and said, I can guarantee you 10 mobile homes a month. And these are new mobile homes, and these folks that he's selling them to put down a $10,000 down payment, and then they get to move them either into a mobile home community or they get to move them onto private land. And when you are on private land, you don't have to, it's private land. Like I said, there's advantages and disadvantages to each of them. It's really a personal preference. So I could certainly give this person a couple a
Okay.
couple of names.
Sounds good. We can maybe put your email, or you said it was info at.
Yeah, it's on this. Oh, I guess I'm not on the screen. It's info@Keyhole, KEYHOLE Connect.com.
Okay, I put it in the chat
Oh,
too,
great.
just in case. So we have another question that says, do you JV on deals?
I'm always looking for investors. And quite frankly, we cannot keep up with the demand, to be honest with you. And so we're always looking. And so the way that I had mentioned we do it is it's on a deal by deal basis, and we talk to the investors, and based on what their appetite is, a lot of them want to just start slow and test the waters. But it usually works that somebody will say, all right, I'm good for 100,000. I'm good for 50,000. And once we find the unit that makes sense for you, then we go ahead. It becomes a private deal. It's a private loan. So Mary, if you said it's $50,000 that you're good for, and we find a unit 50,000 that has a loan guarantee, etc., the deal is that loan is between you, Mary, and the borrower. Boom. It's a personal loan that you're giving to that borrower, between you and that borrower. That
Excellent.
loan guarantee between the park owner is between the park owner and Mary. So now Mary has a loan guarantee. We then service the loans, and it's $20 a month that we service the loans, to make sure that everything goes smoothly. Distributions are paid on a monthly basis. But again, Mary, if you want to contact me, I'd love to tell you more about the program.
Which brings us to thank you, Mary, for your question. Our next question, can you speak a little more on the servicing and fees?
Thank you. Very simple. As far as the fees goes, there's really 3 fees to the borrower. First is the application fee of $95. Second is the underwriter fee that they charge us, which is $695. And then the closing, once everything's done, we have a closing fee of $795. So those 3 fees. All of those fees, we give the borrower an option. You could either pay those fees at closing, or we can roll those fees into the loan. So if the loan is $50,000 and the application fee, the closing fee, and the underwriter fee, let's say, is $1,500, it'd be $50,000 plus the $1,500, it'd be $51,500. So that's the cost that the investor would then pay. Let's say the $50,000 that goes to the seller, the $1,500. He's fronting that money, but meanwhile, the borrower is paying him back, the investor, on a monthly basis. The only fees that we charge the investors are $20. It's $20 a month. and that's really to do the accounting and to take the money in. We make the distributions on a monthly basis. The investors give us their account number. It automatically goes into their account on a monthly basis, along with an email showing them the breakdown of the money that they get.
Excellent. And I do want to add here, if I may, that you can also do this with your self-directed IRA. If you have, funds, sometimes we have more funds in our 401ks or IRAs that we can pull together to invest. You can do this through Quest, and I can help you with that as well. So, something you can do. We have another question from Daphne. Do you finance tiny homes on wheels, park models that are 400 square feet or less?
So that's a great question also. I think she means tiny homes instead of Tony's
Yeah,
home.
you're right.
Tony's been very busy. It's a tiny home. The interesting thing about tiny homes, where I said at the beginning of my presentation that cities and towns don't want to make available spaces for manufactured home communities. There are, and it's just a different zoning, I guess, there are more and more properties that are coming up for tiny homes. And these tiny homes, like Daphne said, they're really small homes on wheels. Most of them are on wheels. And the way they use space is just amazing. It's just a fantastic way that they use space. We're not into that yet. I can see in the future of being in it. I think it's a great concept, as well as RV parks. But there's so much opportunity right now on the manufactured homes, financing them. Like I said, we can't keep up with demand. We're always looking for investors. So hope I answered your question.
And Steven again, if I'm loaning the money to the borrower, do I have to be licensed?
Not at all. This is a private loan between two people. End of story. It's as if you're lending to your brother-in-law, you're lending to your high school friend. It's a private loan that you're lending, and the guarantee is between you, your name, and the park name. So no, you don't have to be licensed.
Okay. And Daphne did say I misspelled Tony Holmes. I like that name though. Manny, so the investor invests on a per manufactured home basis?
Correct. So for instance, in the month of October, we send out to our investors probably twice a month. Hey, here's the availability of different units and what the amounts are and what the IRR that we're giving to the investors. And so right now we have 10 going on for November. So you would look at that list or call me and I'll go over the list. You look at that list and you go, okay, I'm interested in this one and this one and this one. One might be 50,000 and it's giving away 11.5%. One might be 80,000 and it's giving away 12.2%, blah, blah, blah. And so it's done on an individual basis. We don't do it on a fund basis as of yet. There's no real benefit that we see doing it on a fund basis because whether it's individual, each loan has a guarantee with it versus if we did, hey, here's 20 loans that are in a fund, well, all 20 would have the same personal guarantee. So it really doesn't make sense. It's been set up that it's such a rinse and repeat concept. And I think, I've looked for loopholes. I invite people to give me loopholes to kind of improve the program that we have. And so far, I think we have a pretty tight-knit program, like I said, that benefits the borrower, the investor, and the seller.
Excellent. We have, which states does your business cover most?
Good question. So we've done zero marketing. We do a little bit in Facebook. I do blogs and put them in there. And I'm purposely holding back being aggressive with marketing because A, I wanted to perfect the system. And B, we're having trouble keeping up with the demand. So I didn't want to be in a position where I'm in 20 states and meanwhile I have, 40 loans that I have to fulfill. And I'm like, robbing banks to get money, to do this. So I didn't want to be in that position. Right now, we're in about 6 states, Florida, Ohio, the Carolinas, Arizona, Michigan. And really, from a perspective of an investor, it makes no difference where you are. All of them get a guarantee. All of them have to always be covered with home insurance. And that's one of the things we do when we're servicing the loans, to make sure that they're covered with home insurance. And all of them get a title. So they get a title from the Department of Motor Vehicle because it's chattel. And that title says, John Doe's the owner of the mobile home, but Sherman Arnowitz is the lien holder. I'm the guy that's lending the money. I get to hold the title. So the title is sent to me. I hold on to the title until that borrower has paid every last cent, and then we transfer the title back over to the owner.
How long are the loans typically?
From 5 to 10 years. I'd say most folks are doing it in the 10 years. And quite frankly, when they do it in the 10 years, that's the most profitable for the investor.
Excellent. We have a few more questions that I think we can squeeze in, although we're kind of right on time right now. But we have Michelle Walker ask, are these type of loans regulated by the government, interest rates, etc.?
Thank you, Michelle. I love your necklace. They are regulated by the government. And one of the things we take pride is with our underwriters, when the borrower fills out the application, it's automatically submitted to the underwriter. The underwriter then reviews everything and corresponds with the prospect. Everything has to be Dodd-Frank compliant. Every T crossed, every I dotted. Yes, in some states we can't go that high. It's usurious rates, and so we need to be aware of those. But we make sure that we follow all the guidelines of the government, including the interest rates that we can charge.
Excellent. We have, can they refi us out of at any time, or is there a 3-year period where they can't?
At this point, there's no prepayment penalty for them. I would say out of 150 loans I've done, most people take a 10-year. They talk to me about, well, I'm taking a 10-year because it's the least amount on a monthly basis. And that way I can prepay. If I want to do an extra month, if I want to do this, I want to do that. I can't count on one hand how many people have done that. So they're very satisfied just keeping it at the 10.
Awesome. Mary, could I place a mobile home on land that has RV hookups, or does it need to be secured? I have an opportunity to buy a one-on-one home on 3 acres with private 3 RV hookups, no restrictions.
That sounds great. You can put it on this private land. I don't believe I could find you somebody who knows better than me. I don't believe you can do the RV hookups. The mobile home, it weighs a lot more than the RVs. They have to go on these cement mobile home pads. And then there has to be sewage, there has to be electric, there has to be water, there has to be an inspection on that. So I certainly can get you the name of somebody that could answer that.
Right. She did mention she's in Texas afterwards. And then we have Rodney Anderson. Will your investors buy existing mobile home loans?
Sure. I'm assuming you have some that you're looking for us to possibly purchase. The opportunity is there. The whole thing is like a game in the sense that the numbers have to make sense for everybody. A lot of times we'll have owners of a mobile home park. They'll say, hey, I decided 20 years ago to rent to everybody. So the people in all my mobile homes, they're paying me rent. And at that point, they go, I really don't want to do the rent because there's a lot of negative stuff that you have to do when you're renting to somebody. And so we do a whole conversion program for them. No more renting, and now it's a financing kind of thing. So the only way that would work is, my point to Rodney is, the numbers have to make sense for everybody. in order for that to work. But yes, I'd love to speak to you about it, Ronnie.
Excellent. And everyone who wants to talk to Mr. Arnowitz, please go ahead and contact him directly. Seems like there's a lot of interest from some of you here. But thank you, everybody, for your questions and for joining. And of course, Mr. Arnowitz, this is awesome. Thank you so much for your presentation, and we hope to have you again in the future.
Yeah, it was my pleasure. I'm looking forward to speaking to anybody, everybody, anybody. Feel free to give me a call or shoot me an email. Look forward to speaking to you. And thank you again for the opportunity, Angela.
Excellent. Well, have a great rest of your weekends, everybody.
Great.
Bye-bye.
Thank you.